So you probably clicked on this video because you dislike taxes. Or maybe you really hate taxes. Hate is a strong word, but I really don't like taxes either. You might also be thinking, how can you even pay only $750 in taxes, or how that's even possible, and you're wondering how you can do that too. This video isn't about how to pay only $750 in taxes, but how to avoid taxes legally.
But that's a crime.
No, I said legally, so it's not a crime. The current tax code is set up to where you can pay less in taxes if you follow the correct steps, and here are some of the ways that any normal person can do so. Full disclosure before we actually get into the video, I am not a CPA, I'm not a certified financial advisor, I'm none of those things. This is strictly for entertainment. Also, these scenarios totally depend on what state you live in, your filing status, like if you're single or married. So depending on your situation, connect with a certified tax professional for your specific situation. With that, don't forget to smash the like button for the YouTube algorithm. That'll help out my video as well as my channel grow. I'm on my way to 1,000 subscribers, so please help me reach that. Also, it will help you save 15% on your taxes. I'm totally kidding. You actually have to get married for that. I'm kidding again. If you get married, you won't save 15%. It really depends on your situation, how much you'll save in taxes if you get married, but regardless of that, let's get into the video. The first thing that you can do to avoid taxes or lower your tax basis is to modify your W-4. What is your W-4? Well, viewer, if you are an employee at a company, your employer will give you a W-4 form, which basically tells them how much they should withhold from your paycheck in taxes. So I'm actually going to assume that you filed your taxes before and you either had a tax return last year or you owed some taxes in your previous year. If you had a huge tax bill last year where you owed money on your income taxes, consider increasing your withholdings for the next year on your W-4. On the other end, however, if you had a huge tax return in the previous year, you might be thinking, money, money, money. You probably were also feeling that your paychecks were a little smaller than usual, or you thought that you should be getting more money. It's probably because your paychecks were having taxes withheld each and every paycheck. Consider reducing the amount of money withheld from your paychecks to increase your paycheck amount, but also balancing out between whether you're going to get money back or whether you're going to owe money during tax season. The balance or equilibrium between these two situations is actually where you want to be. During tax season, you actually want to pay little to no taxes on your income tax returns. If your paychecks aren't withholding enough taxes and you're spending that extra money along the year, where at the end of the year you're going to be owing money on taxes, you might not even have enough money to pay those taxes that you owe. So you got to be careful on that. Also, if you're withholding way too much money on your paychecks, you won't have enough money to save and invest, or just have any money to meet your needs. And then at the end of the year, when you get your tax return, essentially what that is a free loan to the government with no interest returned to you. The second way that you can avoid taxes is to contribute to a 401k. 401k retirement account is a specific retirement account that's usually sponsored by your employer, which basically reduces your taxable income, any money that you contribute to it. Currently, the maximum amount that you can contribute in a year to a 401k is $19,500. So for example, if you have an annual salary of $50,000 and you contribute the maximum amount of $19,500, you'll only be taxed on $30,500 during your tax return season. So I believe currently the federal tax rate at $50K is actually 22%, but if you contribute the maximum amount of $19,500 to a 401k, that reduces your income and you'll only be taxed, I believe, at a federal tax rate of 12%. It's very significant. Keep in mind the 401k account is pre-tax money, so it's more like a tax-deferred account. You're not paying taxes on the money that you put in it now, but at the age of 59 and a half, when you retire and you start pulling out money from that, you'll be taxed the regular income tax rate at that point in time. Third way is to put money into an IRA. An IRA is similar to a 401k account, but it stands for an individual retirement account that you can just open up without an employer sponsor. There are two types of IRA accounts. There's a traditional IRA account as well as a Roth IRA account. For the sake of this video, since we're trying to lower taxes, I'm not going to talk about the Roth IRA. I'll talk about the traditional, where you can contribute up to $6,000 per year into that account to lower your taxable income. Very similar to the 401k account. Difference is you may not deduct the contributions to your IRA account if you have a 401k account sponsored by your employer, if you're married and filing jointly, but also if your gross income for the tax year is, I believe, $124,000 for the year 2020 or more. The fourth way to reduce your taxes is to invest in your education. Some states and educational institutions actually have a certain account called a 529 account. Contributions to these accounts can't be deducted from your federal income taxes, but they can from the states that actually allow that. So depending on which state you live in, like I said before, look into this and how you can deduct your state income taxes. Also keep in mind a 529 account, similar to a 401k account or a IRA, is a specific account that can be used to invest money in, but it's strictly for educational purposes only. So any money that is in there, any money that you take out after, compounding interest or any gains on the money that you make in that account, you can only use it to pay for school, like tuition, books. It really depends on the specifications for that account. So if you look into this option, definitely look into the details. The next option is to fund an FSA or HSA account. Flexible savings account and the health savings accounts are similar accounts to the 401k and the IRAs, where you contribute pre-tax dollars into those accounts. Personal FSA accounts actually have a maximum contribution of $2,750 for the year 2020, and this money has to be used within a year for medical and health expenses. So you can use it for dental, you can use it for health, you can also use it depending on what you're purchasing, like Band-Aids or wraps or anything like that, with this money. You can also fund FSA accounts for dependents up to $5,000, which if it's a dependent, like if you have a kid or a family member, you can fund their account as a contributor up to $5,000 for the year 2020. So that's more money in your pocket for important expenses and less to Uncle Sam. Aside from that, the FSA account, you have to use it within that year that you contribute to it. Similar to the FSA account is the HSA account, but with different details. The HSA account, you can also contribute pre-tax money into, but the money that you contribute to it carries over year on year. Also, you're only really eligible for one if you have a high deductible health plan. The money that you put into that HSA account doesn't need to be used within a year, like I said, and basically you can take that money and invest it in stocks, bonds, index funds, and then after the age of 65, you can treat it similar to a 401k account if you haven't used that money for health expenses. And then it's just another retirement account. I believe one of my close friends said this is you can't be the richest person in the graveyard, so health is really important. As you're growing older, make sure to stay active, stay on top of your health, eat healthy foods. That way you can reduce the amount of health expenses and not have to pull money from your HSA account and then just have that money grow over time. But it is there just in case that anything happens. You can use that money to pay for an health expense and it wasn't taxed, so that's really cool. Number 6, and we're moving along here, is you can look into the EITC, or the Earned Income Tax Credit. There are certain rules to it, and if you make less than $57,000 a year, you can look into your eligibility. Depending on your income, depending on your marital status, and depending if you have kids and dependents at all, you can get a tax credit of up to $7,000 in the year 2020. It's truly found money because if a tax credit reduces your tax bill down to zero, the IRS might have to give you some or all of that money back to you. Also, remember earlier how I mentioned some accounts like the 401k, the IRA can reduce your taxable income? Say you make $60,000, you're not really eligible for the EITC. But if you contribute at least $3,000, making your taxable income only $57,000, you are now potentially eligible for the EITC. Definitely look into it. The 7th way that you can potentially avoid taxes is to track your medical expenses. So for example, if you've been to the hospital for a one-off visit, or if you've gone to the dentist and you had a bill, keep those receipts. In general, you can deduct qualified medical expenses that are 7.5% of your gross income. So for example, if you make $40,000 as your adjusted gross income, anything beyond the first $3,000, which is 7.5% of your AGI, is tax deductible. So using that as an example, if you rack up a bill of $10,000 in medical expenses, you can deduct $7,000 on your tax bill. We're almost done here, but the 8th thing that you can do to avoid taxes is just give away your money. I'm not talking about just taking your money and burning it or just buying a Starbucks because we know how that goes. I'm just talking about donating it to a charity. Donating money to a charitable organization can lower your tax basis. You also don't necessarily have to give money per se. You can also donate clothing, you can donate furniture to the Habitat for Humanity. There's a lot of things where you can donate something and there will be a monetary itemized value to it that can lower your tax basis. Keep a list of the things that you've donated in an itemized list, whether it's money or items, and then when you hand that over to an accountant or use TurboTax, there's a way to use their software or an accountant will tell you how you can deduct those from your taxes. I don't really like this next one, but it is one that is definitely available to the normal person, is sell bad stocks. If you're a stock investor, and if you are, that's awesome, but sometimes the market doesn't treat you well. Say you invest in a stock and the value of that stock went down because the company went down to zero.
Or say a CEO tweeted something about their stock and then the price just plummeted.
You can actually deduct losses up to $3,000 on stocks to offset the gains from elsewhere. This doesn't make an excuse for poor investing, and I would know because I've made some pretty crappy investment mistakes in the last few years. Also take note, if you happen to sell a stock at a loss and then you're up to that $3,000 tax break, if you happen to buy back into the stock within 30 days, the IRS will look at that and take the tax break back, so be careful what you do there. And the last thing, and number 10 on my list on how you can avoid taxes, is to time your purchases. There is literally a huge difference between making a purchase on December 30th at 11:59 and 59 seconds and January 1st. If you know a huge purchase that is coming up is tax deductible, consider making it within this year versus the next year. Here's a really small example. If you happen to own a home and you're paying a mortgage, consider making the January mortgage payment in December. That will give you an additional tax break on that mortgage interest that you paid a month ahead for the given tax year. Similarly, if you're near the threshold of medical expenses, that 7.5% that I mentioned earlier, you can consider having that root canal done in December rather than January so you can reduce those taxes as well. Also, if you're considering getting married or having a kid,
Get her done.
I'm just kidding about the kid part because it takes months to cook one of those. I'm talking about getting married. But having those things done within a year can actually help you out on taxes as well, because filing single versus jointly can also help you reduce taxes, as well as having a kid can be a dependent or an exemption on your taxes too. The point I'm trying to make from this video is that there are ways to avoid taxes legally, and there are ways to pay only $750 in taxes. Is it right? Is it wrong? It doesn't really matter, because legally at the end of the day, the tax code is the way it is, and the only way that we can make that change is if we go out and vote. I'm not telling you how to vote, I'm just telling you to go vote, because that is an important thing to do these days. That said, everyone, I really appreciate you watching this video. If you haven't already done so, please hit the like button, hit the subscribe button, also ring the notification bell so you know the next time that I post a video on my channel. Here's my Instagram. I post there from time to time, just like everyone else does. But me specifically, I really like cute puppies, so I'm still waiting for one of my viewers to watch to the end and send me a puppy pic proving that they watched this part. So do that. Also, if you're interested in starting in investing, or if you haven't already done so, please check out my links down in the description below to Webull and Robinhood, where you could get 3 free stocks. On Webull, if you fund your account with $100, you could get a stock that is no less than $8, valued up to $1,600. There's also a link to Yada, which is basically a savings account, and any money that you save gives you some tickets, and every week you could potentially win up to $10 million with those tickets. So check those links out. Thanks so much again. I really appreciate it. Stay safe, stay healthy, and with the knowledge that you gained from this video, let's get to work.
Bye.